Hi, this is Daniel, and you're watching Unrivaled Investing. But beware, this is a no hype zone. I am focused on what is fundamentally going to drive your stocks higher or lower over time, breaking down companies so that anyone can understand them. And that way we could, think about what actually could the returns look like in the years ahead. Today, we are looking at Novocure, ticker is NVCR. It's a stock that I invested in July 2020, and since then it's up over 100%. Now, the reason why I'm bringing this up, it's not to be like, yes, 100% in a couple of months. No, that's not why I'm doing this. Like, there's actually a lot of lessons. Mistakes were made. Like, there are a lot of lessons to go through over this. Both that can apply to other investments, as well as like, hey, what could I have done better? So first, like one thing that I think applies to any investment is that particularly situations of volatility. That's really the key point here, is like whenever you have a stock that's highly volatile, I want to ask myself like certain things. I want to think about, certain approaches. How should you think when you have a stock that goes up a lot or goes down a lot? Understand what actually drives those returns, whether or not it goes up 100% or down 50%. What lessons can we apply from Novocure, and how do they apply to other prospective investments? Because there's actually a lot of application to, there's a lot of SPAC investors that I know that get super excited. And I feel like there's some lessons from Novocure that could be very relevant to many of today's SPAC investors. And then lastly, size up what are some of the mistakes I made with Novocure. So the purpose of this video is to make you think, to make you go, what can I learn about my investing journey, as Daniel shares a bit about this unrivaled investing journey. And so 2 months ago, I posted this video. You can still see it on YouTube. So I wrote Novocure, stock analysis, 10x upside, another Livongo. And in full disclosure, I personally own shares in Novocure and Livongo. And so you can see, like, yes, this is one of my first videos. It was pretty crappy quality. I had a Corona haircut at the time, a nice buzz cut, because at the end of the day, my wife gave me the haircut. I love you, honey. But the key points from this were, one, I bought the stock at $60 a share, which was a teaser position. I laid out the thesis for the company, its value proposition, and its growth potential. So if you're, if you want to get the breakdown on Novocure, I'd actually still go back to that video, because much of the core thesis was in that video. Is that all? I actually made 2 more videos about Novocure shortly afterwards, in both cases calling out the 10x potential. Like, hey, it's up 10% in 1 week. Is there another 990% to go? And then I wrote, when they had their second quarter results, 34% growth. The reason why I'm sharing this is this is not to humble brag, like, oh yeah, it's only up 100% in a couple months. That's not it. The reason why is there are so many important lessons to glean from this that I want to go through it, just because it's applicable to so many different types of investments and companies out there. So first is like, yes, so I invested in July, and the stock has gone up over 100% since then. And when we see a chart like this, it actually leads our brains to think the wrong thing. And what do I mean by that? I mean that the monkey brain starts taking over when we're like, oh my gosh, is it still a good buy at $140 a share or $130 a share? Keep in mind, I bought it at 60 just a couple of months ago. And stocks are one of those few goods where as prices go up, it actually causes people to want it even more. And I suspect that's largely because of fear of missing out and greed. I suspect like people are like, oh man, it's gone up this much. Like, let's hop on. Like, I can't believe I'm missing this rally. That's what happens. I think that there's this fear element, but the reality is, like most goods and services, if you see that price escalation, your first reaction isn't like, oh, I need to hop on board. The monkey brain, the deprival's like, oh, I need it. Like, if I see that my double, I get my double, I got my French fries, I get my Neapolitan shake, and I'm looking at it and I'm like, man, if all of a sudden that whole thing costs $20 versus the sub $10, I would say like, well, wait a second. what's going on? I wouldn't be like, oh yes, I need to go buy In and Out, go buy some more because it's now $20 to get this lovely meal. So it's worthwhile recognizing that our brains are wired differently because there's this greed element when it's a good that we need versus a good that could make us money. And the reality is we should treat investments more like that double, where it's like, hey, this In-N-Out cheeseburger, or French fries or milkshake, it's better off thinking like, hey, can I get this on a bargain versus, hey, this has gone up, now I need to buy it. What are some of the other lessons? What do I think the price action means? And the reason why, I started with this question of like, hey, like, is it a good buy now? Like, first of all, I'm not giving advice here. I'm sharing my own personal journey. But the fact that people are asking reflects that this sort of this tendency is popping up because people see the exciting price action. What else does the price action mean? And in all honesty, I think it's largely noise. And you're like, what? Like, I get the occasional nasty gram, for example, on YouTube about, stocks where I think the risk reward isn't that attractive. Where I'm like, you know what? Upside is pretty minimal and downside's pretty significant. I did, for example, a video on big commerce. I've done several videos where I'm trying to be, super straight with you, the loyal YouTube subscriber, where I'm saying like, look, this situation doesn't strike me as super compelling. Now, is it possible for the stock price to go up? Of course it is. So I did a video on big commerce. One video, it's actually down. One video, the stock price is up since then. I've done plenty of videos, some where it's like, hey, I don't think this stock is that compelling, and it then goes up. And then, you know what happens? Then people will go, what an idiot. He thought there was no upside and it's up 20%. The stock, well, he must be such a dope. He thought it was inexpensive. But is that really the right way to think about it? Is that the right way to think about investing? And of course not. Like, that's the same way, Will Ferrell's character from, Wedding Crashers, like when he finds out that one of his friends is getting married, what an idiot, what a loser. Is that the right way to think about, marriage? Like this, it's ridiculous. So I when you're confronted with share price noise, things that are extremely volatile, you always need to ask yourself like, what's actually driving this return, and are you an idiot because you thought something was expensive and then it got more expensive? Of course you're not an idiot just because something went from expensive to more expensive. Something that can go from expensive to more expensive to ridiculous, this can last for years. But just because it happens doesn't mean you got to focus on your logic. Like that's how I'm going to invest. And, maybe you have to reassess like, hey, did I make a mistake with my logic? Maybe my assumptions are off. But, at the end of the day, there are only three things that drive shareholder returns over time. And what are they? These sort of basics. I go through this in one of my first videos, once again, with my Corona haircut. It was one of the first videos. It was called The $1 Trillion Secret to Building Wealth in the Stock Market. And the reality is there's only three things, and it's fundamentals. So what's actually fundamentally driving a business to grow, the valuation change, and distributions, or like dividends or spinoffs, assets that are being distributed to you as a shareholder, whether or not it's cash or a subsidiary. Or if you wanted to go in even greater detail than this, there was a study done where it shows that like over 10 years, your investment return is 70% driven by revenue growth, nearly 20% from margin expansion. And then the rest is, 11% is going to be from free cash flow. So that's effectively the dividends or buybacks returned to you. So the vast majority, as you can tell, is revenue growth. And the last little itty bitty 1%, that's going to be multiple expansion. So over 10 years, you generally find that valuations get wiped out. But that's what everyone loves to get focused on. Like, hey, the valuation doubled in 2 months. That's incredible. While fundamentals, they're still doing what they're doing. The thesis is still the same, but monkey brain gets super excited seeing this price action. You got to remember, over a multi-year, multi-decade perspective, valuation changes get wiped out. What's Warren Buffett have to say about all this? And this is a paraphrase what he said and paraphrase what Ben Graham has written, his mentor. You're neither right nor wrong because Mr. Market agrees or disagrees with you. In the short term, it's this voting machine. Like, ooh, this is so exciting. Everyone can cast this vote, like, and as everyone's voting, that's what drives the stock. But the reality is, longer term, it is this weighing machine where it's like, what is this company fundamentally worth? What should drive its value? And when you see a swing like this over just a couple of months, that's people getting excited. That's a dramatic change in valuation. Over a multi-year perspective, valuation changes tend to get wiped out. So any big gains you get in valuation tend to reverse themselves. So what really matters is this weighing machine. What's going to drive your fundamental returns longer term? So then wait a second, like, Daniel, that can't be right. Novocure, like, this isn't some volatility like 10, 20%. Novocure's up over 100%. Like, that can't be right. It can't just be noise. Like, you're wrong, Daniel. It can't just be noise. And actually, that's pretty much it. Like, there was one earnings release, which was pretty much in line. I did a video on it. And there was a conference call that they had that was separate from this earnings, where they pretty much confirmed that they were on track to expand their addressable market, which is something that I called out in the prior video. So the neither of these things were really groundbreaking. Like, it certainly didn't change the thesis from my very first video. Like, and once again, if you want to learn the details about Novocure, go to that first video. I'll drop the link in the description of this video, where Novocure is a fast-growing business. This is the 30-second summary. It's a fast-growing business with an unrivaled value proposition and a huge market opportunity with catalysts in the next 12 to 24 months. I articulated all of this in that first video. And the point is that, like, yes, you can have things that change sentiment, and that's what caused this valuation change. But longer term, you focus on fundamentals. That's really what's going to drive it longer term. And there's a super important lesson here, and it goes both ways. Those doors don't just swing higher all the time. They can swing in and out. And sometimes stocks will drop potentially a lot on noise. And so, for example, in 2008, I owned a stock that dropped 70%, 70% in one day. Now, the best part about this drop is that it dropped on really dumb news. It dropped on incorrect headlines. Like, I read the headlines and I was like, this is wrong. I looked at the filing like did not match what Yahoo Finance and all these news outlets were saying. And I was just blown away. Like, this stock is dropping 70%. I had a material amount of my assets in. And I'm like, what? So what do you do when that happens? And first, you make sure your underwear is still clean. And the reality is, I put both, a representation of men and women's underwear here, just because I want to make sure women investors, they feel included with these videos. I wasn't proposing that when times get tough, that you swap undies, but if that's your thing, God bless. Okay, so clean undies, good to go. Check. What is next? And next you break out your calculator. Like, where's the price? You reassess the risk reward based on what you think the fundamentals are, based on what you think a reasonable valuation is, and you check your assumptions. Did anything happen that radically changes the assumptions that go into that calculator? Then lastly, act accordingly. Is this an incredible buying opportunity, or were you wrong to own it back when it was much, much higher, before it dropped that 70%? The reality is, and here's a key lesson that applies to all stocks, which is that volatility is the cost of admission to play this game. If you think you're just going to play this game and invest in stocks and it always goes straight up, you're wrong. Volatility is the cost of admission. You're going to see things that are going to drop. It's going to be painful at times. At times, you're going to say, hey, I really need to check my undies. And when that happens, that's part of the game. You got to be able to separate what's noise, however, from what are those fundamentals. Does this company have an unrivaled value proposition, or can grow significantly in the future because they're unrivaled and they're tapping into this huge market potential? Also, this is sort of as an aside, Novocure did fit the pattern that I called out in a recent journey video on finding potential multi-baggers. There's Unrivaled Journey Fishing, where I'm saying like, hey, with Unrivaled Investing Journey, I share my investment portfolio and monthly updates, but I also want to teach you how to fish, not just hand you the fish, teach you how to fish. So there's a multi-part series that I'm just starting up here, where this one is about, hey, here's a certain pattern that you might see with potential multi-baggers. But in order to see this video, you do need to go to unrivaledinvesting.com and join my journey to track my journey to find these potential multi-baggers. And the reality is, all it takes is finding one potential multi-bagger to change your life journey. So if you're interested, you can follow my journey by going to unrivaledinvesting.com. Also, if you're enjoying this video, you enjoy learning about multi-baggers, make sure you hit subscribe. If you're already a subscriber, please hit that like button. Also, I bring this out in every video. I love getting questions and comments or stocks that you want me to look at. That's the reason why I look at many of these stocks. I look at based on the recommendations you guys have. So please drop a note below this video. But let's continue on. What other lessons should we think about from Novocure, from this experience so far? So here's a question. Do you have to buy before a company proves themselves? And so here it is, looking at Novocure's timeline. So in 2000, the founder founds Novocure. By 2004, so 4 years later, you have their first trials on this cancer of glioblastoma. Okay, jump forward 11 years, and the US FDA approves Optune for newly diagnosed glioblastoma. So it took 15 years just before you get approval. Now, I'm sure there were many, venture rounds before that where people could have invested, but they haven't proven their business model. They haven't proven what they could sell at. There's a lot of inherent risks. The stock only started trading in this time period when you had the phase 3 trials in brain metastases, and they approved their second generation Optune system. You contrast this history where they've continued to roll out and try their treatments with new types of cancer. And I bought the stock in July of 2020, 20 years after the founder finds the company. And they had answered so many questions since 2000. Questions like, does this company have a real product? Do they have product market fit where there are people that are actually buying their product? How do they sell their product? Do they have to rely on outside financing? Do they have to rely on some sort of distributor? Do they have channel or distribution risks? Like you can have a company that aces that they have a real product, but maybe they're not actually able to sell it. Are they financially viable? Have you gone from past the initial sales to getting some scale with your product where you're not going to have to rely on outside capital in the future, and that maybe, just maybe, your operations have scaled, that you're profitable, and that all future growth becomes self-financing? The point is, from asking all these questions, is that you can still get a very attractive return after a company has proven itself. You don't have to get in the first inning or even the pre-first inning when people are just getting on the field. You contrast this with what we're seeing today. I'm doing videos left and right on SPACs, and I've looked at several SPACs that haven't even answered these questions, that haven't even proven, questions 1 through 3. Not financially viable. That's not even the first 3. Financially viable, that's well down the line. Like, do they have a real product? Does it have market fit? Do they have any problems selling it? And yet these companies, these SPACs, occasionally these IPOs, they have billion-dollar valuations. So it is sort of a testament to the time as well. But it's something worth considering as an investor of, hey, I recognize some people are making money on these SPACs or some of these companies that may not have proven themselves. But do I have to get involved? And you know what? Some people like to do more of those risky, where you could lose everything sort of bets. And of course, yes, if you had invested in Novocure, before they start generating revenue, yeah, your returns are probably fantastic since then. But do you have to get in, at that point to get an attractive return? The answer is of course not. That when you're looking at a company with a huge potential and potentially an unrivaled value proposition, there's probably years, if not decades, that it's part of the journey for you to hop on. Something to think about. What about position sizing? Is there a lesson there? And for me, I personally bought around a 1% position for my portfolio, and was it a mistake not to buy more? And this is, I save before I make any investment, I save it in an Excel file so I can pencil out like, hey, here's what my risk reward is. And you can tell it wasn't crazy compelling. It wasn't like I was penciling out 35% downside in 5 years and 150% upside over 5 years, 5 to 1 effectively, which really isn't crazy compelling. It's pretty good. But I also, I like the company. And that's the reason why, even though I wasn't penciling out the best risk reward, I wanted at least a starter position or a teaser, something where I could just I could bite into it and track it over time. The reality is I might have been too conservative on what multiple I'd assign 5 years out, but the data points I've seen, like nothing has really changed my own personal assumptions on how I'm thinking about how this could play out over the next 5 years. But at the time, I wasn't penciling out crazy risk reward. Like sometimes you're just going to buy something and you know what? It's not going to be a huge position and maybe it's going to run. And sometimes you're going to buy something and it's going to fall. That's part of the game. That's the reason why I keep going back of no matter what happens, volatility is the price of admission in this game. But you got to be able to A, have clean underwear, and B, act rationally when volatility happens. Volatility happens. Deal with it. Okay, so what am I buying? If Novocure's up over 100% and, in these videos, I'm talking about how it has 10x potential. What am I buying? And the reality is for that, you do need to go to unrivaledinvesting.com, click on journey to see, what am I buying each month? What am I selling? What am I holding? You can't take these shares away from me. There's exclusive content where I'm talking about things like, hey, how to find potential multi-baggers. And the reality is all it takes is finding one potential multi-bagger to potentially change your life. And that's what this journey is all about for me, is trying to find these multi-baggers. So if you're interested, go to unrivaledinvesting.com, click journey. And if you enjoyed this video, learning about what sort of thoughts you should have when you see a volatile situation, make sure to subscribe. And if you're already a subscriber, please make sure to like. Thanks so much.